Hi, family and friends. I'm excited to tell you that I've launched my very first public investment fund powered by Dub Financial. It's on the Dub app. It's called Stay Rich, and I can't wait to tell you about it. I actually have a little presentation, and once I take you through the presentation, I'm going to show you how to sign up. Now, Stay Rich is a very stable fund. It is designed to preserve wealth over long periods of time. I'm expecting it to do about 7 to 10% per year, almost guaranteed. And that's a pessimistic scenario. Obviously, I'm going to try to beat that 10% mark. The more I beat it, the better the compounding effect is going to be over time. The philosophy here is that it's a balanced exposure to all kinds of assets. In fact, actually 4 main assets that are responsible for wealth preservation over time, which are gold, stocks, bonds, and real estate. And then I have dedicated 20% of the portfolio to have kind of a strategic alpha edge, if you will, in order to be able to go in and out of overvalued or undervalued asset classes over the years. Now, it's expected, like I said, to reach about 7 to 10% CAGR, compounded annual growth rate. And I've done about 1,000 Monte Carlo simulations to come up with that outcome, so I'm not just pulling it out of anywhere. It's expected to perform a little bit worse than the S&P 500, but better than an all bond portfolio with a better risk profile than both. So you're not going to have these long drawdowns as if you were in an all bond portfolio or all stock portfolio. You're going to have a very steady climb that's basically, shorting currencies. In a way, shorting means going against. Maybe you'll have a negative year, 1 out of the 30 years, proposed duration, but it's going to be just maybe like a couple percent pullback. It's really not going to go down. It's a very good, stable, very well tested portfolio. Like I said, it's going to contain stocks, bonds, real estate, and commodities, which is basically gold, and I have oil at the moment, or at least oil by way of an energy company called Equinor, which if it gets overvalued, it will exit. It has inflation defense. It holds gold, which is an asset that is known to preserve purchasing power over very long periods of time. It has TIPS, which are inflation protected bonds, and they preserve their purchasing power. They use what's called the CPI, Consumer Price Index, in order to determine how much they're going to be paying each year. And real assets like commercial buildings that pay rent. The fund is meant for wealth preservation. It's not made to get you rich, hence the name. It's called Stay Rich. So if you put money in there, you will stay rich. You'll keep that money and it will compound safely over time. You're not going to lose that wealth. Right? If something goes wrong in the markets, it's not going to fall. You have bonds, you have gold, you have cash, you have real estate, you have tips. It's not going to be wiped out with the market. In fact, at the moment, there's only about 25-30% exposure to any kind of stocks at all. Now, this is a deep dive into the current holdings of the fund. You can look through them. If you're a little bit of a stock nerd or an investment guru genius, you can take a look at exactly what I own by ticker. Currently, I have a little bit of TLT, actually, a short-lived 9th position for a strategic benefit off of the undervalued 20-plus year bonds. And these are the results of the Monte Carlo simulation, basically telling you that the base case scenario, which is the mean outcome, is about $500,000 off of $100,000 starting point in 30 years. So it's going to 5x, or it's going to multiply your money by 5 in 30 years. But in my opinion, that's a bit pessimistic, obviously. Here's a bigger breakdown of the simulations. The S&P 500 in 30 years will make $100,000 into $1,750,000. And the optimistic scenario of the Stay Rich fund will end up about $1 million. And the probable scenario is going to be about $500,000 in 30 years. And an old bond portfolio is going to be under $400,000. So it's going to outperform bonds, but probably underperform the market. However, it has the benefit of having significantly less risk. It's nowhere near as risky as the market. In fact, like I said, if the market dumps, it might go down a few percent because it has stock exposure, but it could get offset by gains in bonds or the cash or gold or what have you. So it's not guaranteed that there'll be a down year if the market crashes. These are additional simulations with a $10,000 investment per year on top of the $100,000. In 30 years, you could end up from anywhere between 1.18 million to 2.14 million. So if you're a power saver and you're able to put away 10 grand per year, you're looking at being a multimillionaire in a 30 years period. This portfolio is, I can't understate how stable it is. It will not lose. It's not going to gain much, but that's what we're giving up. We're giving up the extra gains from the hot stocks that might be out there in the markets. It doesn't have any of those. It's not going to build you any wealth, but it will preserve and slowly grow. It's a pillar of stability. It's not going to move around, and you can withdraw the money at any time. If you feel like you need the money tomorrow, the market's crashed, let's say, well, guess what? The money you invested here with STAYRICH, they're still going to be there. You can take them out and do whatever. You can pay bills, help yourself if you're in trouble. It's not like the economy goes down, the market goes down, and now you can't pull out because you're 50% down. So that is the benefit of being invested here. It's going to have an active component. I'm still going to try to build a little bit and compound over time, but for the most part, it's just going to be 1 or 2 or 3% over inflation per year, which is a lot better than, let's say, a savings account and with almost as much risk. Okay, so it's battle tested, it's historically tested. Now, I hope that you enjoyed that, or at least you got a gist of what the fund is all about, the portfolio is all about. Like I said, it is going to be actively managed to a certain extent. About 20% of it I'm going to be managing, but for the most part, in order to improve the predictability and the look-through of the returns, I'm going to leave most of it sitting there. About 75-80% is going to be pretty static year to year, and only a smaller component, about 20%, I'm going to be changing up and down. Now, if you're wondering how to sign up, the process is pretty straightforward. You just basically download the Dub app. In fact, why don't you contact me, your friend or family member? So just shoot me a text, and if you've lost my number, then get it from someone. Shoot me a text, or you can actually text the number that was on this presentation earlier. I also have one dedicated for new. Let me see if I can pull it up again. For anyone new, because I'm going to be leaving this in a public domain, so you can see the number right there. It's 1-669-200-9031. So you can text me there, and if you want to schedule a call, you can text me there, and I will put time aside so we can talk. You don't even have to be like invested in the fund. If you just want to talk to me, that's fine. We can schedule a call. I am, by the way, not a public advisor. I'm not a financial advisor. I'm not a CPA or anything like that. Not a CFA. I have spent many 20 plus years in the markets though, and I know, but I will not be giving you individual advice. Okay, that's for personal financial advisors to do. This is not, a financial recommendation, because one would need your personal situation in order to assess. The reason I'm not is not because I'm not capable of doing it, but actually because I've spent so much time in the markets, I know the handcuffs that these titles actually put you in. They actually limit my ability to do stuff out there. Like, I probably wouldn't be able to do this fund, at least not very easily, and put it out there for anyone to invest in. I probably would not be able to speak freely. Okay, my freedom of speech would be limited, and I would not be able to talk about stocks, individual names. I wouldn't be able to do any of that. It would just be a bunch of disclosures, and I have to watch what I say all the time, and I have to live in fear of getting my license revoked, etc. So it's actually, and then I have to do, ongoing requirements. I have to pay yearly fees, and it's just it's a lot. So you really have to be in it 24/7 in order to fulfill all those requirements, and I don't want to do that. I want to be a professional investor. I want to do what I think is best, and I don't want to dance on somebody else's music and follow their requirements. I want to be able to be free, and that's my edge. I am free. So those licenses will actually just shackle me down. Having said that, going through the sign-up process is fairly easy. Like I said, you will get my referral link. That gives you like an extra $20 or something at the moment. If you want, I can walk you through the process, but it's pretty simple. You will just click the link, download the app, and then it will take you through regular brokerage sign-up questions that you would have to answer anyways if you are opening up any kind of brokerage like Charles Schwab or E-Trade or Robinhood or Webull or whatever. They will ask you some personal questions because they're required to by law, and this is a legitimate broker. Dub is a legitimate broker. They are licensed. They are an actual broker, and the difference between them and other brokers is basically that you buy funds like mine instead of buying individual stocks. So it even has a dollar symbol in the front to remind you that it's a ticker, financial ticker of some sort. So you would just click on the search for STAYRICH. My fund will pop up. You click on it, you say copy portfolio, and then auto copy it for whenever I make changes. Deposit some funds. Up to $1,000, it will instantaneously grant you to be able to deposit that day, that moment. If it's any more, it will have to wait a specific clearing period for the money to be available, and then you would have to go in and deposit again. I would recommend though that you do like a monthly installment, so that way the money can build over time and you don't have to think about it, and the fund, your money will grow at a much like higher rate that way. So you can think of it as like a forced savings account that just grows with a rate a lot higher than a normal savings account. Currently the rates are about 3.5% for a high yield savings account, and I'm going to be doing anywhere from 7 to 10% per year. So I will more than double the rate of a high yield savings account that you can get from a bank or a CD or something like that. So if you have any questions, like I said, feel free to reach out to me. I will guide you through the process if you're confused, or if you just want to chat and say hello. I'm right here. All right, with that said, thanks guys. Peace.